Hello and welcome to Enroll. In this class, we will check out the next answer. What are all the various types of loans and advances paid by commercial banks? In the previous class, we checked out what are all the different types of deposits accepted by the commercial banks. The second major function performed by the commercial banks is to lend loans and advances to the customers. So SAQ 37 explain different types of loans and advances paid by commercial banks. Okay, so as usual, let me briefly explain to you and then we will come back to the answer. Okay, so different types of loans and advances paid by the commercial banks. So the first one is the demand loans, which is also called as call loans. So these are the features of the demand loans. So these loans have to be repaid by the customer on demand by the bank. Okay, just like the demand deposit, the bank has to pay the money to the customer on demand by the customer. Demand loans, the customer has to repay the money back to the bank whenever the bank demands it. Okay, so these loans have to be repaid by the customer on demand by the bank. So normally the bank does not give any notice to the customer. At the most, some temporary notice is given to the customer for a period of maximum 7 days is given by the bank for the customer to repay the loan. Okay, and whatever the entire loan amount is carrying the rate of interest, and it is also called as call loans. Okay, because whenever the bank demands, whenever bank calls, the customer has to repay the amount borrowed to the bank. Okay, this is only under exceptional circumstances the bank demands the money back whenever the bank feels that the borrower is not trustworthy, or if the business of the borrower is not doing well. So the bank feels that the customer might not repay the loan. So if the bank feels insecure that the customer might not repay the loan back to the bank, at that point of time the bank can demand from the customer to repay the loan back within a very short period of time. That is at the most maximum only 7 days notice is given to the customer. Okay, so this is the demand loans, and these loans are lent by the bank with or without the security. Okay, then next type of loan advanced by the bank is something called as the short term loans. So the name itself says it is for a short period of time. So these loans are lent by the bank for a short period of time, maybe say from 3 to 5 years. Okay, mostly these loans are lent to meet the working capital requirements for business. So that were to purchase the raw materials, to provide the labor charges, or for the agricultural purpose to buy the seeds, fertilizers, so like that. So for the working capital requirement, and all the banks can also lend to individuals in the form of personal loans. That is a short term loan. And the thing is, entire amount, how much ever the loan amount is sanctioned, the entire amount is considered as a loan, and the entire amount carries the rate of interest, and the customer has to hypothecate or pledge the security. So these loans are lent against security, and the repayment can be done in installments, but the entire loan amount along with the interest has to be repaid before the maturity period of loan. See, that means what, the customer can repay the loan in installment. Let us assume the loan period is for a period of 5 years. Okay, so within this 5 years the customer has to repay the principal amount along with the rate of interest has to be repaid by the customer within this 5-year period. Okay, so that is a short term loan. Next, moving on to the next type of loan advanced by the bank is something called as the cash credit. So the cash credit, in this method, what the bank does, the bank is opening an account on the borrower's name, and the amount is credited in the borrower's account. So the lend by bank by opening an account on borrower's name. Okay, and the borrower can withdraw how much money, but of course certain maximum limit is specified. Even though it is how much money, the up to a certain limit. Okay, so the borrower can withdraw how much ever money subject to the maximum limit required from the account and also as and when he requires. So the money amount, the maximum amount is sanctioned by the bank to the customer, and then the money is deposited in the borrower's account. The customer need not have to withdraw the entire amount. Okay, so the customer will not withdraw the what is the maximum required. So the customer approaches the bank for the loan, for the maximum loan, and the bank sanctions in the form of cash credit, and that money is deposited in the customer's account. Okay, the customer might not be needing the entire amount at one shot. So initially he might be needing only 5% of it. Okay, so how much ever the customer requires, the 5% of it the customer withdraws. Later on another 2% withdraws. After a couple of months the another 2%. So like that, how much ever money the customer needs at a particular point of time, he can keep on withdrawing in the form of installments. So how much ever money the customer withdraws at a particular point of time, the rate of his interest is charged only for that amount of money withdrawn. Okay, it is not like short term loan. Short term loan, the entire amount is sanctioned, and the entire amount, whether the customer uses the entire amount or not, the rate of interest is charged on the entire amount. But as far as the cash credit is concerned, the customer is not charged on the entire loan amount. Entire loan amount is credited in his account, and then how much ever the customer is withdrawing from that account, only to that much amount the rate of interest is charged. So that's why the rate of interest is charged only on the actual withdrawals, not the whole amount. And these loans are also lent against security. Okay, then the third type of advances loans provided by the banks is something called as the overdrafts. Or the third type, the fourth type. Okay, so overdraft, so this is the special kind of facility provided to the current account holders. So these current account holders, they are given this facility of overdraft to meet the short term needs. That is for the temporary requirements. If there is a temporary shortage of funds, if the current account holders are facing that, to tide over that situation, the bank is allowing this facility mainly to the current account holders. So customer can withdraw more than the amount in his or her account up to a specified limit. That is the overdraft, overdrawing more than the balance available in the customer's account. Okay, so up to a specified amount, the customer can withdraw more than the balance available in the account. See, this is the difference between cash credit and overdraft. Cash credit, the amount is sanctioned, deposited in the customer's account, and then how much ever balance is available, up to accordingly only the customer can withdraw. But whereas in the case of overdraft, the customer can withdraw more than the available balance in the account. Okay, and here also the interest is charged only on the amount of actual withdrawal. Okay, the customer can withdraw the amount already available balance plus extra more than the available balance. So more than the available balance, how much ever he is withdrawing, only to that much extent the rate of interest is charged by the commercial banks. And these loans are lent with or without security. Sometimes the banks can lend or provide overdraft facility to the current account holders even without security. Okay, so you have to make a note of it, which are all how, in what way the rate of interest is charged, and what are all the types of loans the bank is providing against security, what are the types of loan the bank can provide without, even without security. Okay, please make a note of all those things. Okay, for your understanding the differences between short term loans, cash credit and overdraft, so that the concept will be clear to you. See, the short term loans, the entire amount sanctioned is considered as loan. Okay, and the interest is charged on the entire amount. Whereas in case of cash credit, the amount is sanctioned up to a certain limit by opening an account. Okay, the entire amount is not considered as loan. Only the amount withdrawn by the customer is considered as loan, and the rate of interest is charged only on that amount. So the customer withdraws in the form of installments, and how much ever is withdrawing, only on that amount the rate of interest is charged. And whereas the overdraft, the customer can borrow or withdraw more than the available balance in the account, and the interest is charged again only on the actual withdrawals, and this one is with or without the security. Whereas the short term loans and the cash credit both are lent against security. Okay, so this is the next type of loans or advances made by the paid by the commercial banks. Okay. Another type of advance pay made by the commercial bank is something called as the discounting of bills of exchange. So now what is a bill of exchange? So bill of exchange is it is a kind of document or undertaking given by the buyers to the sellers. See, for example, the wholesaler or the mostly possessed by the traders. So now the wholesaler gives the sells the consignment to the retailer, and the retailer buys the consignment on credit basis. Under that situation, the retailer gives a bill of exchange to the wholesaler stating that so and so amount will be paid by me to the so and so wholesaler, and this is the amount and this is the date the amount will be paid. This is simply like buying on credit basis. Okay, I'm just giving you an example. See, if I assume that a wholesaler sells fabric worth rupees 2 lakhs to a retailer. Okay, now the retailer gives a bill of exchange because at this current point of time he doesn't have 2 lakhs to pay, so he's buying on credit basis. So the retailer gives a bill of exchange to the wholesaler stating that rupees 2 lakhs will be paid to the wholesaler after 6 months. Okay, so this will be clearly mentioned in the bill of exchange. So 2 lakhs will be paid to so and so person after 6 months. Okay, what is the date of maturity? Before that, the whole retailer has to pay the amount to the wholesaler. On that assurance, the wholesaler gives or sells the consignment to the retailer. But if the wholesaler requires money, maybe say the wholesaler maybe it is not possible for the wholesaler to wait for 6 months. Suddenly some emergency occurs, so the wholesaler needs the money immediately. So what he can do, he can approach the bank. So but if the wholesaler requires money maybe due to some emergency before 6 months, the wholesaler can approach the bank and present this bill of exchange. Okay, so what the bank does, the bank advances loans to the wholesaler against this bill after deducting certain percentage by crediting the amount in the account of the wholesaler. So the bill amount is 2 lakhs. So the wholesaler presents this bill of exchange to the bank. So the bank might not give him 2 lakhs. Okay, maybe the bank gives some 1,75,000. Certain amount is deducted depending upon the rules. Some percentage is deducted by the bank, and the remaining amount is credited to the wholesaler's account. And what the bank does, after 6 months, the bank collects the entire amount from the retailers. So even though the bank is paying 1,75,000 to the wholesaler, because the bank is helping the wholesaler in the times of emergency, isn't it? And after 6 months, the bank is collecting the entire 2 lakhs from the retailer. So this difference again becomes the profit to the commercial bank. So this is the discounting bills of exchange, because after making a certain discount on the bill of exchange, the bank is lending the loan or crediting the amount to the borrowers, that is the wholesaler's account. So that is why it is called as the discounting of bills of exchange. Mostly these are all the documents possessed by the traders whenever the transactions are done on credit basis. Okay, then another popular method nowadays which we all know aware of is something called as the credit cards, isn't it? Now what is the credit card? As banks are issuing the credit cards to the customers. I mean, each and every card has got its own limit, we all know that. So what the customers are doing, the customers can purchase goods or services using the credit cards up to the limit is also prescribed, and the firms are collecting the money, the required amount of money from the banks, and later the card holder pays the required amount of money to the bank. Okay, so again we have certain types of cards meant for specific sections of the people. Like for farmers we have the Kisan credit card. Okay, understood? So these are all the various types of loans and advances provided by the commercial banks to the customers. So these are various financial instruments, financial assistance provided by the commercial banks to the customers. Okay, hope each and every type is very clear to you. The concept is clear to you. Now let us go back to the actual answer. So SAQ 37, explain different types of loans and advances paid by the commercial banks. Answer: the second most important function performed by a commercial bank is to give loans and advances. The first function is the acceptance of deposit. So that's why the second most important function is the advancing loans and payments. Okay. gives loans and advances to different sections of the public out of the deposits received. How the commercial bank is able to lend the loans out of the deposits received from the general public. The various types of loans and advances made by a commercial bank are: first one, demand loans or call loans. A demand loan is a short term loan that the borrower must pay back whenever the lender, that is bank, demands it. Okay, thus these loans do not have any specified maturity period. The entire loan amount is credited to the borrower's account in lump sum. The entire amount carries interest from date of credit. These loans are made with or without the security. They are also called as call loan. So the demand loan is provided in lump sum by crediting the amount on the borrower's account, but whenever the bank demands it, the customer has to repay the amount. That is a demand loan. Then the second one, short term loans. So the short term loan, so this is like a difference between the term deposits and the demand deposit. Demand loan, payment on demand. Short term loans, cash credit, they are all payment after the maturity period. Okay, short term loans, these loans are given for a specific short period of time, usually 3 to 5 years. They are sanctioned against security for temporary business requirements to business people, farmers, etc., and also to individuals as personal loans. The loan amount has to be repaid along with interest before the loan tenure ends, that is, before the maturity period of the loan. The rate of interest is charged on the entire loan amount sanctioned. Whether the customer is using the amount or not, the loan amount, the interest has to be paid on the entire loan amount. Third one, that is C, cash credits. Cash credit is provided by bank by opening an account on the borrower's name. The customer can borrow money from this account up to a specified limit. It is more flexible than loans, as that is short term loans, as the customer can withdraw as and when he needs it, either fully or partly. Rate of interest is charged only on the actual amount of withdrawal. The customer has to pledge security to the bank. Okay, the next D, overdraft. This is a temporary facility allowed by bank to the current account holders to meet their short term needs. The customer can withdraw more than the available balance in his account up to a certain limit. Interest is charged on the amount of actual withdrawal. This loan is lent with or without security. Okay, next E, discounting of bills of exchange. Bills of exchange are the undertakings returned by the buyers and given to the sellers, ensuring to make the payment at a future date when the transaction is made on a credit basis. This bill can be presented by the seller to the bank for loan if he is in urgent need of money. That is, if the seller cannot wait till the credit period. The bank lends money to the seller with or without security against this bill of exchange after deducting certain amount. That's why it is called as discounting of bills of exchange. And finally, F, credit cards. Nowadays, the most common method of transactions are made by using credit cards. The customer can purchase goods or services against these credit cards up to a certain limit. The firms collect the amount of bills from the banks which issue the credit card, and the card holder pays the amount to the bank at a later date. The card holder can also draw cash subject to certain limits specified by the bank. The card holder can also withdraw the money. Certain sections of the population are given specific cards. Example, Kisan credit cards to farmers. Okay, so thus these are all the various types of loans and advances paid by the commercial banks. Okay, so again I repeat, I hope each and every type of loan is clear to you. If you find this video useful, please like, share and also subscribe to my YouTube channel. And if you have any doubts or suggestion, please mention in the comment box. Okay, until my next class, take care. Bye bye.